Hello everyone, my name is Miles, and welcome to the Buckner Project series on financial literacy videos. Today I'm going to talk to you about a very interesting topic, investing, and how doing it smartly is very important to make your money grow. In previous videos, we've talked about the 50-30-20 rule and how you should save money from your income for emergencies and investments. But there is a difference between saving, which is putting money aside for future growth, and investing, which is to make it grow. Saving is what you do with the money you're going to use to pay for short-term goals, ones in the next 2 to 3 years. You will usually put that money in an account where you can access it easily, also called liquid, and where it is safe, such as a high-interest savings account or even a certificate of deposit, if you're confident you won't need these funds until a certain date. Investing is what you do with money earmarked for long-term goals like buying a house or retirement. With a long time horizon, you can make growth rather than liquidity the priority. You can buy an investment like a stock or bond with the hope that its value will increase over time. Although investing comes with the risk of losing money, should a stock or bond decrease in value, it also has the potential for greater returns than you'd get by putting your money in a bank account. So why should I invest? What's wrong with simply playing it safe and keeping all your money in cash? One big reason is inflation. Inflation is when the price of the product you buy go up. Over time, inflation erodes the purchasing power of cash. If the current inflation rate is 3%, when you go to spend a $100 bill you stashed in a coffee can last year, that money will only get you $97 worth of groceries compared to what it would have gotten you last year. In other words, the cash you've been sitting on doesn't buy as much as it used to because everything has gotten 3% more expensive. Inflation can severely erode your purchasing power over time, and that's why you should invest to make your money grow and counter against inflation. The other reason is the power of compounding. When you earn interest on savings, that interest then earns interest on itself, and this amount is compounded monthly. The higher the interest, the more your money grows. The longer you allow your investment to compound, the more it will grow. This is why you should start investing from an early age. Start small, but keep up the habit of continuously investing. Types of investments. Investing has risks. The goal is to manage them. The best way to do this is to have a plan, know when you'll need the money, and diversify your money across different types of investments, which I will cover next. Stocks. One of the most common but more risky investments is stocks. A stock represents ownership in a company. When the stock price increases, you can sell and make a profit. You can also earn money in stocks through dividends. Stocks can also go down in value, and then you lose money, which is why it is risky. Bonds. A bond represents a loan you make to a government, municipality, or corporation. In return, that issuer of the bond promises to pay you a specified rate of interest and to repay the face value after a certain period of time, barring a default. ETFs, an exchange-traded fund, called ETF for short, is an investment fund that generally holds one specific asset class, like stocks, bonds, or commodities. Most ETFs are considered passive investments, also known as index funds, meaning they track a market index. For example, an ETF that tracks the S&P 500 index is trying to mirror the performance of companies in the S&P 500. Mutual funds. A mutual fund pools money from many investors and then invests that pool in a broad range of investments, such as stocks, bonds, and other securities. A mutual fund is managed by a fund manager. When you buy a mutual fund, you buy a stake in everything the fund invests in, and any income these investments generate. Mutual funds make it easy to build a diversified portfolio and get professional management, so you don't have to research, buy, and track every security in the fund on your own. You need to be older than 18 or 21 years old before you can invest on your own, but this is a time to get familiar and understand investing. A great way to do it is to make investment with the help of and under the supervision of your parent through a custodial or brokerage account. Your parent will have to sign you up for a custodial account offered by an online broker, and there are many like Schwab, Fidelity, SoFi, and others.